I would like to offer a warm welcome to all our participants today in what is the start of a series of webinars discussing the new CT regime in the UAE. For those of you that don't know me, my name is Joe Pacelli. I'm the new leader, head of tax for KPMG in the Lower Gulf, and I look forward to meeting many of you over the ensuing weeks and months as we follow this exciting journey. These are, of course, exciting times in the UAE. It was following the introduction of corporation tax on the 1st of June. We at KPMG are here to help our clients navigate the complexities of the new legislation, and we would very much welcome our interactions, as I say, over the following months. I would like to introduce Wasim, who is our head of corporate tax and international tax, who will be walking us through this afternoon's session, and he will talk in more detail about the agenda in the next few moments. We will be specifically looking at the transitional areas and the free zone areas, and I very much warm welcome Wasim. Thank you, and I will hand over to you.
Thank you, Joe. Thank you for the introduction. Actually, I would like to welcome you all to this webinar. It seems we have a full house, actually. We have around 1,000 participants in this webinar. We'll try to make it simple. My name is Wasim Shaheen, and I'm heading the corporate tax here in the UAE. Actually, in this webinar, we will focus on two major points and major topics that are really the talk of the town. One of them is about the free zone, the qualifying free zone, as you know. I will have also another topic to be covered by my colleague, which is the transitional rules, and we will do only an extract of one topic of this transitional rules. Now, with me, I have a team of directors and specialists in the field. I would like to introduce them all. I'll start with the tax director, Ellie, and Niha. She's also an associate tax director. And I have also with me Hassan. He's also a tax director, and Harsh, he's a tax manager. Now, each one will cover a certain topic on an area in this webinar, starting by the free zone, and then we will move to the transitional rule. Actually, just a little bit of housekeeping points. There will be a recording for this webinar, so we'll share it with you. And there will be also an evaluation form that will appear at the end of the webinar. So I appreciate if we can get your feedback on that. Now, you know, it's not obvious to have to witness in a country where they are introducing a new tax law, and the CT law is really a kind of exciting time for us as tax professionals, and we are looking forward to more challenges as we go. You have seen and noticed during the past couple of weeks, the Ministry of Finance has been extremely, if you want, aggressive on issuing all the ministerial decisions and the cabinet decisions. And honestly, things are moving in the right direction in this respect. Now, 1st of June has come. And tax is now a fact of life. We have to deal with it, and the free zone is part of it. So now, what we need to just focus on is that we will tackle different points. We will not just read from the ministerial decree or the decision from the cabinet that were issued lately, we will try to give a context to the matter. We will give our own interpretation of the matter. We will give some considerations that you have to, as tax professionals, you have to, and businessmen definitely, businesses, you have to take into consideration while approaching the aspects of the free zones. Now, in terms of the history, why is it important? Everybody knows that the free zone is part and parcel of the economy of the UAE. And it's a major topic because thousands and thousands of companies have been established in the free zones in the past. And then this increased, and we have a lot of interplay between the free zones and the main. Now, few concepts were introduced by the ministerial decrees that were issued. Before that, if you remember, we had the consultation document. They mentioned something about the free zones. Then we had the law, which mentioned only 2 articles, 18 and 19, and honestly, a lot of interpretations and kind of talks about what do we mean by qualifying income and non-qualifying income. A lot of talks in the market, but the legislators, it seems, the legislators had a different point of view from whatever was there in the market. And now we have more clarity. Certain issues are still yet to be resolved, but I think we have more clarity on how the legislators are approaching the corporate tax of the free zone in the UAE. Now, how we are going to approach the seminar from that perspective. First of all, I will have an overview about what the concepts of the free zone and a qualified free zone in the city law. Then we will move to a specific treatment of the immovable properties owned by qualified free zones and their treatment, how they are taxed. My colleague Niha will do that. Then we will move into and dive into the 2 decrees, one which is the cabinet decision issued, number 55, issued by the cabinet lately, last Friday, and the ministerial decree 120, which was also issued on Friday. That will be covered by my colleague Ali. Then Harsh will give us a kind of an example, an overview example about the treatment. It will be like a kind of summary, if you want. And then after that, we will move to the transitional rule with my colleague Hassan. To start with, let me go to the definition of certain terms that are relevant to the free zones. The law itself, it mentioned about qualifying free zone person and qualifying free zone. The qualifying free zone person was defined in the law as a free zone person that meets the conditions of Article 18 of the decree of the law, decree number 47. So it was a new concept introduced in the law, whereby they defined what is a qualified free zone. And then they mentioned about the qualifying income, and they said in the law itself that if a qualifying free zone if it has a qualifying income, then this income will be subject to 9%, and it has an unqualified income, it will be subject to 9%. Okay, that's the definition that was given in the law itself. And now, with more details, we can understand what's the logic behind the qualified income and unqualified income. But before we dive into the decisions and the details of this definition, I want to highlight that the qualified free zone person is a resident person from city perspective. And this resident person means that it is a taxable person, whether it will be at 0% or a 9%, or we will talk about the possibility of the free zones being taxed under the BEPS rules, which most probably it will be 15%. Now, if you have and you will be classified as a qualifying free zone person, then this will apply for the remaining period of the free zone authority that has the the exemption period. So in this respect, the government can extend the lifetime of the free zone where the qualifying free zone exists, but it can do otherwise. Now, if you are a qualified free zone person, and we will see the conditions later on, but if you are qualified free zone person, then ideally you should not be subject to tax and you should be subject to 0% tax. And you cannot benefit from the small business relief that was issued by the Ministry of Finance. And you cannot benefit from the 375,000 dirham threshold. You cannot be part of a city grouping. And for those professionals who are now aware what a city group, you can group companies together if you own more than 95% in general, and you can offset the losses with the profits of a certain member of the group. So qualified free zone person cannot be part of a city group. It cannot be part as well of what we call a qualifying group, where you can transfer losses if you own more than 75% directly or indirectly. So you cannot be part of that. You cannot benefit from this kind of transfer of losses in a qualifying. Also, you need to look at the VAT considerations, and I will have one or two slides later on. I will touch base on that. You have to worry about the TP requirements because in the law, the TP, the qualified free zone, as we will see in a minute, that they have to abide by the arm's length principles and the transfer pricing principles. Also, another consideration I want to draw to your attention that also there are special treatment for qualified free zone person when it comes to what we call participation exemption, and this should be looked at it separately. We move on now to one or two slides about Pillar 2. I don't want to spend a lot of time on Pillar 2, but just to draw the attention that the companies in the qualified free zone companies or free zone companies in the UAE that are part of a multinational entity that falls under BEPS 2.0, where their revenues are more than 750 million euros and other conditions are met, they might be subject to a different treatment from the Ministry of Finance perspective. So they might fall under the, if the 15% will be the global minimum tax and the UAE adopts that, then they will not be subject to 0 or 9, they will be subject to 15%. And hence they have to take this into consideration when they do their tax planning. Now, as you know, there was an exclusion like in December and there are special rules where multinational entities would be excluded from the application of BEPS during a transitional period, and the conditions are, there are 3 tests. I will not spend too much time on that, but one of them, if the constituent entity has revenues less than 10 million euros and net profit of less than 1 million, for example, they will be excluded from the application of BEPS. Anyway, this is a consideration that I think should be monitored properly, whether during the transition period till 2026, before 2028, or after that. This issue of having the free zone or qualified free zone being subject to 15% is a serious consideration for multinationals. Now, we can move on to the qualifying free zone persons. the law itself mentioned 4 conditions for a free zone to be classified as a qualified free zone. And I think you know by now that these 4 conditions, which were this entity needs to maintain adequate substance, it should derive a qualifying income, and that was the, if you want, a big question mark. What is the definition of a qualifying income? Then the third condition was that this free zone does not elect to be subject to CT, and I will touch base on that in a minute. The fourth condition is that all the transactions with related parties should be at arm's length, and they should maintain the proper documentation for transfer pricing with their local file, master file, and so on and so forth. Then the decision that was issued, the ministerial and the cabinet decisions, they mentioned 2 additional requirements and conditions for a free zone to be classified as a qualified free zone, and hence ultimately generally subject to 0% tax. And these conditions are, they have to have audited financial statements. So now they introduce the requirement of having an auditor to sign on audited financial statements. And they have also mentioned that these any non-qualifying revenue should not exceed a certain de minimis requirement. And you might wonder, what do we mean by de minimis requirements? I would leave that to my colleague Ali later on to explain the definition of non-qualifying revenues as well as the de minimis, in addition to the qualifying income. So if you want, 3 definitions, and this list of conditions will be clarified later on. So to recap, 6 conditions need to be there. If this free zone fails to meet any one of these conditions during a certain year, then it will lose the hat or the classification of being a qualified free zone during the year that the failure occurs, and 4 years after that. And this is very, very serious. What is the de minimis and what is the qualifying income? What is the unqualifying income in this respect that will put us in a failure position? We will cover that with Ali. Now, 2 points I want just to mention quickly: that the free zone can elect to be subject to CT, so it will not be anymore a qualifying free zone. It will be a taxable entity, and this taxable entity, once they do the election, they can be, definitely they will be taxable at 9%. They can benefit from all the reliefs that we were talking about, whether it is the, for example, the 375,000 dirham exemption for the first bucket would be subject to 0% tax, and they will benefit from being able to join a CT group, a qualifying group, and so on and so forth. All the benefits that a taxable person can enjoy as per the CT group. Now, for the ESR regulations, I don't want to spend too much time on that. I just want to mention that there is no reference in the decision about having the board to meet in the UAE, yet to be clarified by the ministry. The ESR rules originally that were in place and applicable for a couple of years now, they mentioned that there should be the board here in the UAE. Here we don't have this reference. Now, also the decision mentioned that the qualifying free zone entity can do outsourcing, and they can outsource their activities, certain activities, to a free zone person. So they cannot outsource to anyone except to a free zone person, and not to anyone in the UAE. They can do that, but they have to monitor the company that is taking the outsourcing activities. Now, we move on from the qualifying free zone to the treatment of immovable property by a free zone person. I would leave my colleague Niha to dive into this aspect. We decided to take this if you want, topic before we go into the definition of qualifying income, unqualifying income, and so on and so forth, as per the decisions. So we concentrate and we focus on the tax treatment of the income generated by a qualifying free zone when they own properties, whether they own them outside the free zone or inside the free zone, or whether the property, the movable property, is a commercial property or a residential property, or whether the, if you want, the other party of the transaction with the qualifying free zone is a free zone person or a non-free zone person. I hope Niha will guide us through all the details. Over to you, Niha.
Thank you, Wasim, and good afternoon, everyone. So as Wasim already briefly mentioned, on this slide, what we intend to cover is to understand the treatment or the taxability of income earned by a free zone person from any immovable property that it has. Considering the importance of real estate sector in the UAE's economy, it is indeed not surprising that the decisions released have made special rules and also certain carve-outs for income earned by a free zone person from an immovable property. While the rules are fairly complex at first glance, the taxability of income earned from immovable property is dependent on various factors such as the location of property, whether the property is commercial or non-commercial in nature, and with whom is the free zone person transacting with, which results in the income relating thereto. So there are also certain specific exclusions under the de minimis rule, which my colleague Ellie would be covering later on, for the income which is earned from immovable property. Now, considering that the tax result would be different depending on whether the concerned property is commercial or non-commercial in nature, it is indeed important to understand what really constitutes commercial property for the purposes of the free zone regulations or the taxability of entities set up in free zones. The cabinet decision has provided a definition of commercial property, which you can see on the right side of your screen. And it essentially says that a commercial property is a property which is used for the purposes of a business or a business activity. It also has an exclusion for any property which is residential in nature. What is interesting to note is that any accommodation which is in the form of hotels, service apartments, or motels, or any similar properties, those are also excluded from the definition of commercial property. So they would be treated like non-commercial properties for the purposes of understanding taxability of income from immovable property for the purposes of free zone persons. With this background, let us now look at the various scenarios which are possible and how the tax treatment of the same will work for a free zone person. To start with, we look at the scenario on the right side of the screen, where we have non-commercial, where we have a scenario where the free zone person has a property which is located not in a free zone, in fact, on the mainland. In this case, irrespective of the category of property, whether it is commercial or non-commercial, and whether the transaction is with a free zone person or a non-free zone person, this income would be subject to tax at 9% in the case of the free zone person who owns the immovable property. Now, if we move to the left side of the screen, where we have a scenario of a non-commercial property located in a free zone, and the free zone person is earning any income from this non-commercial property. Though the property is located in the free zone, but in lieu of the fact that the property itself is non-commercial in nature, this income also would be subject to 9%. So to give an example, if a free zone entity has a residential property or even a hotel in a free zone area, the income from the same would be subject to 9% tax. And finally, we look at the third and last category, which is of commercial property located in a free zone. In this case, there are two categorizations which we need to make depending on where the income is coming from. So if the income comes from a non-free zone person, the income would again be subject to 9%. However, if the transaction is with a free zone person, this income becomes a qualifying income. In summary, this means that the only possible good income, so to say, for a free zone person earning income from immovable property is that of the income which it earns from a commercial property located in a free zone, and the income as well should be earned from a free zone person. This particular income would become a qualifying income, and the tax treatment of this income would be dependent on whether the free zone person owning the property would be regarded as a qualifying free zone person or otherwise. With this, I hand it back to Ellie, who would take us through the various categories of qualifying income, which are specified in the ministerial decision, as well as the taxability of a qualifying free zone person.
Thank you, Neha. So let's dive in and define the parameters of qualifying income. What are the income categories of a qualifying free zone person which can benefit from the favorable corporate tax rate of 0%? In this context, we will discuss the scope, definition, and also the framework of several key concepts. This includes the qualifying income, qualifying activities and excluded activities, non-qualifying income, excluded income, and the already mentioned de minimis rule. So as you can see, the qualifying income category as specified in the Cabinet Decision number 55 covers three categories. Category A outlines that any income derived from transactions between free zone persons will be considered qualifying income unless the income is from an excluded activity, which we will cover in the next slides. Category B mentions that any income from transactions with a non-free zone person, provided that that income relates to activities that are defined as qualifying activities, will be considered qualifying income, again provided that those qualifying activities are not excluded as excluded activities in the Cabinet Decision. The third category is the final catch-all clause, which says that any other income earned by a qualifying free zone person can still be considered a qualifying income, provided that the qualifying free zone person satisfies the de minimis rule, which we will also outline in the next slides. Maybe now moving on to the exclusions. So before diving into the details of these specific income categories, I would like to draw your attention to two explicit exclusions from the definition of a qualifying income. So according to the Cabinet Decision, there are two types of income of a qualifying free zone person that shall be considered as taxable income, subject to the standard corporate tax rate of 9%. Firstly, the first category is the income attributable to a domestic or a foreign PE. So in this context, the PE, where usually is not considered as having a distinct and separate legal status from the head office, as the PE is considered to be an extension of the head office, will be actually treated as a separate entity. So for the purpose of determining the taxable income of the qualifying free zone person in a specific tax year, the PE of a qualifying free zone person is treated as a separate and independent person and is also considered to be a related party of the qualifying free zone person and hence subject to the transfer pricing regulations, meaning that all transactions between the head office and the permanent establishment need to be performed at arm's length conditions. The second category is, as my colleague Neha already mentioned, is any income from immovable property located in a free zone to the extent that that income is derived from a non-free zone person or non-commercial property. But I won't spend more time on this. Now we can move on to our first category, which is the qualifying income from transactions between free zone persons. Here, the exclusion is that all income from free zone persons, between free zone persons, are considered qualifying unless the income is from an excluded activity, which de facto means that any income from excluded activity will not be treated as qualifying income, regardless of the transaction parties. Now, the list of excluded activities. The ministerial decision includes a list of activities that are considered as excluded activities. To mention several prominent activities on this list are the regulated activities, such as the banking, insurance, and financing and leasing activities, which are subject to regulatory oversight. But also the ownership and exploitation of immovable property. So this is, as was actually already also mentioned by my colleague, and the exploitation of intellectual property assets. So this is in brief the list of excluded activities. Now we can move on to the list, the second category, which basically defines any income from transactions with a non-free zone person as being qualifying to the extent that that transaction relates to a qualifying activity that is not excluded activity. So similar to the excluded activity list, the ministerial decision also provides a list of qualifying activities. So what are considered qualifying activities? As we can see here, these qualifying activities mentioned on this list will basically mean that these activities will be considered as qualifying income. So income from these activities will be qualifying income and hence eligible for the 0%, unless the activity is excluded activity or auxiliary to such activity. To highlight several of key activities, the first is the manufacturing of goods and materials. Also mentioning the holding of shares. So this will be very relevant for holding companies based in the UAE. And there is an illustrative example later in the presentation. Mentioning the distribution of goods and materials in and from a designated zone to customers that resell or alter such goods for the purpose of reselling those goods, i.e. business to business. The concept of designated zone will be discussed further by Wasim in the presentation. So there are definitely certain sectors not yet mentioned in this list. So we will need to await further clarification in this regard. The final category is category C. So this category, in short, says that any income that is not captured by category A and B can still be considered as qualifying income, which means that the legislator in this respect has chosen to allow a qualifying free zone person to maintain its status as a qualifying free zone person, even if the qualifying free zone person has income that are not de facto or considered to be qualifying income as described in category A and B, as long as that income is below a certain amount. So in this provision, any other income, regardless of the source and the activity, could be considered qualifying income if the de minimis rule is met. And again, to recapture, qualifying free zone person in this concept, in this category, can have income that is not captured in category A. So it's basically not transactions between free zone persons, as well as category B, not captured by the qualifying activity test. What is the result of this test? This test means that if the income is below the threshold that is defined in this rule, the qualifying free zone person will be eligible for the 0% treatment of the non-qualifying income. The non-qualifying income in this context is the amount of income from non-qualifying activities where the counterparty is a non-free zone person. In this case, very important to mention is if the test is not met, i.e. the income exceeds the threshold, the qualifying free zone person will become taxable at 9% in the current year and subsequent 4 years, as already mentioned in the introduction. Hence, the free zone person loses the qualifying free zone status. Now, a brief description of the formula. Looking at the formula itself, the formula mentions that your non-qualifying income, so the non-qualifying income derived by a qualifying free zone person, will be, let's say, below the threshold if it does not exceed the lower amount of 5% of the adjusted total revenue, which we will clarify, as well as, so the lower of 5% of the adjusted total revenue, or the amount of 5 million dirhams. So the first point to clarify, the first definition, again, is this non-qualifying income. What falls under non-qualifying income? The sum of any income from excluded activities, as was captured in category A, and any income from non-qualifying activities where the counterpart is a non-free zone person, category B. Now, to calculate the adjusted total revenue is where we take the total revenue of the qualifying free zone person and adjust that by deducting the excluded income, which we mentioned before, excluded income being the income from domestic and foreign PEs, and as well as the revenue from transactions involving commercial properties. So basically, the correction is that the excluded income is not part of the formula to calculate the de minimis rule. So once we have the amount of the total revenue minus the exclusions, we take 5% of that amount. If that amount is lower than 5 million, then that becomes our threshold. If the amount is higher than 5 million, we stick to 5 million. So basically, in this context, we have met our de minimis rule following this this formula. Wasim, over to you.
Thank you, Ali. That was a lot of information actually to. Yeah, thank you, Ali. That was a lot of information to swallow in a short period, but really, it was really comprehensive. Look, before I dive into the VAT considerations, I just want to mention a couple of points. As you can see that, you know, the concept of qualifying free zone person is a new concept. And it's not automatically that a qualifying free zone person will be taxable at 0%. So there is always a worry that if they derive other income, then they have to wait until they see the end result, do this the de minimis test as Ali has mentioned, and then they have to see whether the whole income will be subject to 9% or the whole income will be subject to 0%. Now, if a qualifying free zone, as Ali said, will only do activities with a free zone, and these activities are not excluded activities, then ipso facto, the net income will be 0% and they don't have to worry. And also, if they have income from non-free zone persons, and it's very important to note that the decree did not specify what is a other free zone person. They did not specify at all. So it is left for interpretation. But if they have these transactions with non-free zone person, then they have to have a qualifying activity definition, and they should fall under the qualifying activity and not excluded activity to be treated as qualifying income. If they fail this, they are not part of the qualifying activities, then the income will be taxable at 9%. If they have other income, we go to the de minimis. And having said that, we have to also mention that the business to consumer or the dealing with the natural persons are within the excluded activity. So the qualifying free zone, when they deal with the consumer directly, natural person, then these are treated as excluded activity with few exceptions, mainly dealing with the wealth fund management and what have you for investment funds. Very few exceptions as part of the qualifying activity. So the qualifying free zone person cannot do activity with a natural person and treat them as qualified income. They will be part of the excluded activity. Now, for the banking activities, as you know, branches of foreign banks, they are subject to tax at Emirates level, 20%. Now, the banking was very clearly mentioned in the excluded activity. If they are regulated, and this means that they will be subject to 9%. So they will be at the federal level subject to 9%, and at the emirate level, if they are a branch of a foreign entity, they will be subject to 20%. Now, if they are not branch of a foreign entity, they will be subject to the 9% unless they fall under BEPS regulations. Now, having said that, I would like to mention a few points about VAT, just to draw your attention that there should be a thorough study to be done by all businesses, qualified free zones and the free zones, etc., from VAT perspective to see the interplay between the CT and the VAT. Now, nothing is mentioned about that in the decisions, but by comparing the VAT treatments of the free zones in the VAT law and the regulations and looking at the city law, we can conclude the following. First of all, the VAT does not cover in itself treat the free zone separately. So any activity that is done or transaction done by a designated zone to another designated zone, from VAT perspective, they are classified as out of scope. Any transaction done by a designated zone entity to a mainland entity, then these are subject to 5%. Any transaction done between a designated zone entity and an outside UAE entity, they are part of the out of scope services. Now, if we move to the next slide, you will see that a supply of goods from a designated zone to the mainland, from VAT perspective, they are out of scope if ownership transferred in a designated zone. And they will be treated as taxable from VAT perspective if ownership is transferred in mainland. Now, from CAT treatment, you can see, and I think Ellie has explained that clearly, that will be a qualified income when you have a designated zone selling to a customer that this customer will resell it later on. So it's a business to business, and hence based on the qualified activity, this income will be treated as qualifying income. Now, the supply of goods from a designated zone to another designated zone, as we said, that is out of scope if not consumed within the designated zone. From CT perspective, it will be qualified income and subject to qualified activity. And the supply of goods from a designated zone to an outside UAE entity, it will be an out of scope from the AT perspective, but it will be a qualified income subject to qualified activity test. Now, I won't go through all the list. That's something that we wanted to draw your attention that you need to go and see the interplay between the VAT and the CT when it comes to free zones and qualified free zones. Now, I would like to move to my colleague Harsh, who will guide us to an example, comprehensive example, actually, about the holding entity in the free zone, the qualifying free zone, and the treatment from CT perspective. Over to you, Harsh.
Thank you, Wasim. So basically, we'll just proceed with a case study on a typical holding structure, which is commonly used by the business groups based in the UAE, as well as the multinational groups who set up a regional headquarter in the UAE for the Middle East operations. So in this example, we'll look at how the free zone tax regime will have an impact on a typical holding structure. So diving into the key aspects is basically there is a company A which is set up in a free zone. It holds 100% shares of company B, which is a mainland entity. It also holds 100% shares in company C, which is a foreign entity or an overseas entity. Company A also has a branch in the mainland UAE. And importantly, company A, just like any other typical holding company, also owns an intellectual property asset. So the typical income streams which a holding company will have is basically dividend income from the subsidiaries, interest income on the intercompany loans or the shareholder loans. Sometimes it also receives management fees for rendering headquarter services and royalty income on account of owning the intellectual property assets. So how would this income streams be taxed considering the new free zone tax regime is what we'll look now. So basically the dividend income which is earned from company B, which is a mainland UAE entity, it will be regarded as a qualifying income because it is derived from the qualifying activity of holding shares and securities. Such income being derived from a domestic entity will be exempt from tax under Article 22. Further, dividend from company C, which is an overseas company, even this income would be regarded as a qualifying income because it is derived from the qualifying activity of holding shares in securities, and it would be subject to 0% corporate tax. Moving on to the third income stream, which is interest income received from the subsidiaries. It would be regarded as a qualifying income because it is derived from the qualifying activity of rendering treasury and financing services to related parties. It is important to note here that these services are to be provided to related parties only, in which case the income would be subject to 0% corporate tax. The management income would also be regarded as a qualifying income because it is derived from the qualifying activity of rendering headquarter services to the related parties, in which case the taxability is again similar to what we discussed earlier, is 0% corporate tax. Now coming to royalty income, which is also important because this income would not be regarded as a qualifying income owing or on account of this activity of owning and exploiting an intellectual property asset is a excluded activity, and therefore this income, if it is within the de minimis threshold, it will be subject to 0% corporate tax. However, if the income exceeds the de minimis threshold, there is a possibility that the qualifying free zone status person is lost, and all the income streams which we have discussed earlier could be subject to 9% corporate tax. It is important to note here that if the qualifying free zone status is lost, company A can also consider seeking participation exemption for the dividend that it receives from the overseas company. So that is an option available with company A as well. And lastly, profits of the mainland branch will not be regarded as a qualifying income because it is clearly subject to 9% corporate tax. However, it is pertinent to note that this income will not be included in the de minimis threshold calculation. So that does not affect the de minimis calculation. So with this, I conclude the case study, and now I hand it over back to Wasim to talk about the transitional rules.
Thank you, Harsh. That was very comprehensive, very good example. Now let's conclude on the free zone. So we take you to one aspect of the transitional rule. I hope it was beneficial for you. Now, just to set the expectation, I think we might run a couple of minutes late. So I think 5 minutes after 4 we'll be done with that. Now, my Hassan colleague, we will cover the transitional rule, but that's just as an introduction. As you know, the Article 61 of the CT law has mentioned that the opening balance sheet for the first tax year of the taxpayers will be the closing balances of the prior year, subject to certain adjustments. And these adjustments, they might be specified by a ministerial decree by the minister. And this is exactly what happened. The opening balance sheet should be prepared as well at arm's length basis, taking into consideration any violation of GAR rules. So the ministerial decree that was issued, number 120, highlighted few adjustments in this regards. Hassan will take us through an important extract focusing on the adjustments that the taxable person can make on capital gains that might be realized in the future on immovable properties. So we are going just to concentrate on a immovable property, and in particular example of a land. In this respect, Hassan will focus on the conditions for an immovable property to be classified as a qualifying immovable property, and explain to us the option that a taxpayer has when computing the taxable gain and related exclusions, assuming a piece of it. We will not at this stage cover the impact on the accounting treatment on the financial statements, any deferred tax asset, deferred tax liabilities. We leave that to another webinar. And just to conclude, this election provides a considerable relief for taxpayers and reinforce the concept of neutrality and fairness. That was a very positive news for those who hold assets, immovable assets and other assets, but we will focus on immovable assets. And now over to you, Hassan.
Thanks, team, for this informative session about the free zone. Thanks, Wasim, for this introduction. As Wasim already mentioned, this relief under the transitional rules, but it precisely handles the relief for capital gain realized before the first tax year, and similar to any relief in the law. It covers different kinds of assets, immovable assets, intangible assets, and financial and liabilities. Financial assets and financial liabilities. But in this example, I will handle the most important asset, which is the immovable assets, and precisely land. In order to benefit from the election for the exemption of the capital gain, part of the capital gain, certain conditions should be met. Three conditions actually. Holding test, the asset are owned before the first tax period. It should be owned before the first tax period. For example, a company with a tax period from January to December, this asset should be in its balance sheet before the first tax period. Measurement test, the assets are measured on a historical cost basis. It means that the asset in the balance sheet should be at historical cost. And the gain test, it means that the assets will be disposed of or deemed to be disposed of at a gain, which is above the cost or not book value. Okay, these are the conditions, but we should not stop here. In order to benefit from the election, an application from the relief, an application should be submitted within the first tax in the first tax return. And after we submit this application for an election for the relief, upon disposal of the asset, we should select between two methods to calculate the capital gain. These methods available in the next slide, as we will see, there are the direct method and the holding period method. The difference between the holding period method and the direct method, the main difference is that under the direct method, we have to compare the market. We have to get actually the market value at the first date of the first tax year. Okay, and as if we should elect this price, we have to elect this price. We can go to the relevant government appraisal authorities in order to get the value of this asset at first date of the first tax year, which assuming will be 1st January 2024. And then when we this market value, we take from it the cost or the net book value in order to get the capital gain that can be excluded. Under the holding period method, actually we don't care about the valuation of the asset at the first date of the first tax period. Actually, what we do, we look into the price, the actual price at the date of sale. Okay, and this actual price, we get from it out the cost or the net book value of the asset, which is higher, and calculate the actual capital gain. But there is another step under the holding period method. We have to get the holding period before the first tax year. Yani we have to count the days from the date of acquisition till the first tax year, and we have to count the days from the first tax year to the date of disposal, and get a percentage or formula, as we will see in the next slide. Okay, in the next slide, okay, this is an example of computation of the capital gain under the direct method. As you will see in the slide, it's very simple. On 1st January 2024, we have to take the market value, and then the gain from which is 400 plus 100 at 300, it will be the gain. Will be the gain will be excluded. Assuming that we will sell and the price will be 500, 100, which is the difference between 500 and 400, the elected price at 1st January 2024. The 100 will be subject to tax, while the 300 it will be excluded. So in this method, we have to go to the relevant authorities in order to get the valuation of the asset on 1st January 2024. While in the other method, which is the holding period method, as you will see in the next slide, okay, we have to calculate the number of days from the date of acquisition till the date of sale, and then the date of acquisition, the number of days from the date of acquisition till the date of 1st January 2024, and do a pro rata and calculate the capital gain. The capital gain calculated will be the actual capital gain, but the gain that will be excluded, it will be based on the percentage of the number of days before the date of acquisition till 1st January 2024. Okay, and I will leave it now for Wasim to conclude. Thank you.
Thank you, Hassan. That was very clear and comprehensive. And that's definitely very good news for a lot of companies in the UAE. They can exclude the gain realized before the introduction of the law, and that's something that that was really taken very positively by most of the businesses in the country. Now, to conclude, you see the free zone aspect is not as it was expected. So a lot of people, they thought that it will be very simple. Doing business with the mainland will be taxable. Doing business with the free zone entity and abroad will be subject to 0%. It was not the case. They went with the activity, they went with the type of activity, they went with the other party of the transaction as well, and they went also with the type of the asset that we are generating income from. So a lot of complexities in this regard. Some people are benefiting, are going to benefit from these free zone treatments. Some companies, they will not, but this is a fact that we have to deal with it. And definitely more clarity will be there in the market in the coming weeks or so. I would have told you I wish you a good weekend, but as you know, the Ministry of Finance usually issues on Friday a ministerial decree for tax people to read during the weekend. So I'm expecting once the webinar is over, a ministerial decree will appear, and then we will spend the whole weekend reading it. Anyway, I wish you a happy weekend, and hopefully it was a beneficial webinar. Bye-bye.